from the smartphone in your pocket to the car you drive. Tiny computer chips power nearly everything we use every day. Now, a major change in U.S. trade policy could affect how much those chips cost and what you pay for the products that use them. The United States government has announced plans to implement a 100% tariff on imported computer chips that are manufactured outside the country. This decision was revealed during an Oval Office event on August 6th, where the administration stated that companies producing chips within the United States would be exempt from a tariff. At this time, there is no confirmed start date for the policy, and the exact rules outlining how it will be applied have not yet been made public. Because of that, industry experts say it is too early to fully predict the exact effects, but there are several likely scenarios based on what is known so far. Semiconductors, commonly referred to as computer chips, are a core component in countless products. They're used in smartphones, laptops, desktop computers, video game consoles, medical devices, household appliances such as refrigerators and washing machines, and even in modern cars. Some experts estimate that the average person uses products containing more than 100 chips in a single day without realizing it. Chips are essential for processing, controlling, and storing data in today's technology, meaning any change in their cost or availability can have wide-reaching effects across multiple industries. The United States already has a significant semiconductor industry. According to U.S. Census Bureau data, the country exports roughly $58 billion worth of semiconductors annually. However, the U.S. specializes in producing higher-end, more advanced chips for demanding applications such as powerful processors and advanced communications equipment. Lower cost, more basic chips are often imported from countries like Malaysia, while some of the most advanced, specialized chips are imported from Taiwan. Overall, the U.S. imports about $60 billion worth of chips each year. Experts point out that producing lower-end chips domestically is generally more expensive in the U.S. compared to countries that have specialized in that segment of the market. This is due to differences in labor costs, infrastructure, and manufacturing capacity. As a result, it has often been more economical for U.S. companies to import those products and focus domestic resources on areas where the U.S. has a competitive advantage, such as research-intensive, cutting-edge semiconductor production. In recent years, there's been increased attention on building more chip manufacturing capacity within the U.S. In 2022, the CHIPS and Science Act was signed into law, providing funding and incentives for companies to construct new semiconductor facilities and strengthen the domestic supply chain. Some progress has been made, with new facilities being built and planned, but experts caution that it will take years to significantly scale up production. Manufacturing semiconductors requires highly specialized equipment, cleanroom facilities, and a skilled workforce, all of which take time to develop. Supporters of the tariff say it could encourage more companies to invest in U.S.-based production, potentially making the country less dependent on overseas supply chains. However, some analysts warn that introducing additional costs to companies that rely on imported chips could slow down the very progress the U.S. is trying to make in building up domestic manufacturing. Higher import costs may reduce the available funds that companies can invest in new facilities, research, or workforce training. When it comes to pricing, the expected impact of a new tariff is still uncertain. While a tariff on imported chips will likely increase costs for manufacturers, its effect on consumers may not be as large as tariffs on other materials, such as steel, aluminum, or automobiles. Nevertheless, experts say that any increase in production costs could eventually be passed down to consumers in the form of higher prices for goods like laptops, appliances, vehicles, and even some medical equipment. The extent to which prices rise will depend on several factors, including how much of a given product's production cost comes from semiconductors, how willing companies are to absorb the additional expense, and whether they can find alternative suppliers. In automobiles, for example, chips make up only a small percentage of the overall cost, but the automotive industry is already dealing with other tariffs and higher expenses in areas like raw materials and logistics. Adding another cost layer could put additional financial pressure on manufacturers. In some cases, companies may choose not to pass all of these extra costs directly to customers. However, that can only last so long before it affects profitability. Some automakers have publicly stated that tariffs on various products have already cost them billions of dollars in recent quarters. If import costs rise further, it may become more difficult for them to shield consumers from higher prices. One area where consumers could feel the effects more quickly is in repairs and replacement parts. If imported chips become more expensive, the cost of repairing items such as cars, computers, or appliances that require those chips could increase. Repair shops may be more likely to pass these costs directly to customers. This could also have an indirect effect on insurance rates if insurers face higher claims costs for repairs. There is also the possibility of limited product availability. While a tariff is not expected to create the same kind of shortages seen during the COVID-19 pandemic, when supply chain disruptions made it difficult to get chips at all, it could still influence production decisions. If manufacturers decide it is not cost-effective to produce certain products in the same quantity, availability could decline in some market segments. For example, if a product relies heavily on imported chips that are now significantly more expensive, a company might reduce production or delay product launches. The COVID-era chip shortage had widespread impacts, slowing the production of cars, delaying the release of consumer electronics, and driving up prices in several sectors. The current situation is different because chips will still be available, just a higher cost for certain imports. That means the likely result is more about pricing pressures and selective production cuts rather than severe across-the-board shortages. Industry experts emphasize that the real-world outcome will depend heavily on the final details of the tariff policy. That includes which specific types of chips are covered, whether certain industries or products receive exemptions, and how quickly the policy takes effect. It is also unclear whether the tariff will be a temporary measure or a longer-term trade policy. For consumers, the most important takeaway is that this development could gradually influence the prices and availability of a wide range of everyday products. The degree of impact will vary. Some products may see no noticeable change, while others could become more expensive or harder to find. In the coming months, companies across multiple industries will likely adjust their sourcing strategies, explore domestic production options, or renegotiate supplier contracts to manage the new costs. Policymakers, industry leaders, and trade analysts will be watching closely to see whether the tariff achieves its intended goal of strengthening U.S. chip production without causing unintended negative effects for businesses and consumers. Until more information is released, the full impact remains uncertain. However, what is clear is that semiconductors are now as strategically important as any other major industrial component, and decisions about their production and trade have far-reaching consequences in today's interconnected economy. Stay informed on the stories that matter. Subscribe now for more reliable news and in-depth coverage.